Welcome to Insight. Industrial property market conditions in Australia remain robust. Occupied demand in the second quarter improved significantly after a slow start to this year. There's been more than 350,000 square metres of gross take-up recorded nationally, with Sydney and Melbourne leading the way. Significantly, the majority of take-up continues to be in the pre-lease and turnkey market, which will result in an increase in new building starts over the coming months. New supply remains constrained and heavily pre-commitment led. Around 650,000 square metres has been completed so far this year. 91% of that was pre-committed on completion. There is a pipeline of around 800,000 square metres for the second half of 2016, which will see new supply below the 10-year average again this year. Despite the reasonably balanced supply and demand fundamentals, there has been limited rental growth in most markets as developers and owners of existing space compete for tenants. There's been very little market rental growth for existing stock reported by JLL operatives in the past year, and we continue to witness the ongoing urban renewal of industrial land in mature markets and new infrastructure initiatives that will reshape our major cities. We're encouraged that this will generate greater activity in the industrial sector and benefits to industrial occupiers in core markets. The investment market remains buoyant across all property quality spectrums. Despite recent global financial market volatility, investor demand for well-located, well-tenanted Australian industrial property is dwarfing the quality of investment opportunities. We expect this investment mismatch to persist for the remainder of the year. A number of portfolios have recently transacted, and the unsatisfied capital will be seeking a new home in the sector. We continue to believe that this is a great time to consider recycling capital via asset sales or disposing of non-core real estate or typically less liquid styles of properties. A key question remains: how low can property yields go? We've seen further record low rates on long-term sovereign bond yields, including the Australian 10-year bond, while borrowing costs remain constrained and a very wide spread between property yields and the risk-free rate persists. We believe investors will continue to allocate more capital to real estate, and purchasers will continue to bid up the price of good quality property. Don't forget to check out Insight for all the latest news and research, as well as the current industrial sales and leasing opportunities from JLL. Thank you.